following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
It's time once again for Volatility Views, your weekly source for information on all things volatility. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network. And I am joined today, as always, by the yin to my yang, indeed the dark side to my light side, good old Don Schlesinger from the Volatility Exchange. Don, welcome back to the show.
I don't know about that dark side thing. I think I liked Viceroy and Major Domo better last year.
Yeah, that's true. Did you run those titles by Bob and the team over at Volex? Have they agreed to change your business card?
Yeah, I have to get my business cards reprinted.
Yeah, well, that's a small price to pay for such impressive titles. I know a directors meeting coming up, I think next week. You can ask them there as well if they approve those titles for you.
Good idea. We'll put it on the agenda.
Maybe you throw in Prussian Archduke into the mix as well, and we'll really just have an impressive array of titles.
Now, the only Archduke I knew got assassinated.
Yes,
so
that's true.
I don't know if I want that title.
That's true. I don't know if you want to follow in the footsteps of Archduke Ferdinand. Then, of course, it might be flattering then if your assassination did indeed prompt World War III. So maybe there's something to be said for that being a historical footnote in that sense. But I think with that historical assassination image in mind, which is a very bleak image to start the show, we're going to dive right into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the show where we look back on the week's worth of action from a volatility perspective. And we had a bit of a truncated week this week because, of course, we recorded early. I should say late, actually, on Monday, so we pushed it into this week. So we're looking back at a 4-day time horizon as opposed to a 5-day time horizon. And as we're recording this at our usual time, around noon central here in good old Chicago, most of the major indices are pretty much unched on the day, with S&P and NASDAQ down fractionally and the VIX up fractionally on the day, but no real action. Certainly nothing compared to yesterday, where we saw 1% moves in the S&P and 1.5% moves in the NASDAQ. So there has been some activity to speak of this week, so perhaps we'll start there, Don, in your favorite neck of the woods, which is, of course, NASDAQ volatility land, and there has been some actual movement. We saw some actual realized volatility this week, Don. I'm not sure if it was enough to live up to the inflated levels we've been seeing in the implied land, but at least enough to give us something to talk about.
Well, we got a kick in both NASDAQ and the S&P, and you might recall in the Crystal Ball segment that at the end of the last show, I did kind of intimate that realized volatility levels were low enough so that if we had to forecast a direction, I was looking for somewhat of an increase short term. NASDAQ went from 12.12 up to 14, which is a decent little jump for just a couple of days, and S&P went from 1077 to 1149. So both are clearly higher, and we did have a good deal of market movement during the week. I forget what the VIX level was to start the week. We're at about 15.3 3 right now. I think that's more or less in line with where it was, but we did have it in the 16s for a bit, and then it tapered off once again.
Yes, there was some interesting developments going this week here from a volatility land. It's interesting to watch because we'll typically see, like we saw yesterday, the 1% move in the S&P. The Dow is usually a little bit of a laggard, and NASDAQ of late really has been just leading the charge, it seems, across the board, moving 1.5% yesterday, just being the vanguard of all the moves we've seen of late. Of course, a lot of that isn't surprising. A lot of the major components of NASDAQ have been moving quite a bit of late. And of course, I always joke to Don's great dismay that NASDAQ is not but Apple Plus. And of course, Apple has been moving dramatically as well over this past week. So a lot of the big players in NASDAQ really seem to be contributing to making NASDAQ a bit more interesting from a vol perspective than the S&P has been of late. We've been talking about the S&P for quite a while being this kind of implied vol is low, but there's still a premium to realize, so there's still a trade there, but it's a bit of a dangerous one, a bit of a difficult one to execute, and that's kind of been the recurring refrain in S&P land for quite some time, whereas in NASDAQ we get a little bit more, I think, interesting of a trading environment just because of some of the more activity we've seen, and it sets up, I think, a little bit less of a trade with such an explosively dangerous upside potential compared to what we're seeing over in S&P land. Is that your takeaway as well there, Don?
Well, I think it's interesting because I often talk in the crystal ball segment about the Volatility Institute. The Volatility Exchange is partnered with Professor Robert Engel at NYU and the Volatility Institute over there, and they furnish us with these forecast vols or forward-looking predictions using his modified Garch technique for 1 month, 3 month, and 1 year realized volatility. I think our listeners know that historically NASDAQ has somewhat higher realized volatility than the S&P, but that in recent days, even in recent weeks and months, the two have been reasonably close to each other. We just started the top of the show with my saying S&P realized vol going back a month is 11.5, and NASDAQ is 14. 3 months going back, S&P is 12.5, and NASDAQ is 15. And even 1 year historical volatility, kind of interestingly, S&P 17.5 and NASDAQ 18.9. So they are unusually close for the fact that historically NASDAQ has been considerably higher. So to address your point and looking forward, when we look at the Volatility Institute predictions, there is quite a disparity between the predicted realized volatility of NASDAQ and S&P over the coming year, and nothing like the retrospective, if you will, or backward-looking values that I just related there. And so we've got NASDAQ 1 month at 17, 3 months at 19.3, and 1 year at 23.8. Those are Garch predictions. Whereas S&P is just 12.5 for 1 month, 13.5 for 3 months, and 15.75 for 1 year. So if we want to hang our hat on this type of forecasting, the year to come ought to see NASDAQ volatility widening its gap with respect to S&P volatility.
NASDAQ definitely looking like the angry older brother, perhaps, to S&P vol in this environment. Gives you a little bit more bang for your trading buck. Speaking of bang for your trading buck, we are joined right now by good old Andrew Giovinazzi. He is the other major domo. There's two major domos on the show these days, but he's the other major domo coming to us from optionpit.com, beaming in all the way from the hinterlands of Maine. Andrew, very glad you could join us today, sir. Your timing actually is quite good because Don and I were just pontificating upon the week's worth of action, both from an S&P vol and a NASDAQ vol perspective. You just heard Don and I chatting about how NASDAQ seems to be a bit more of a more intriguing play from an implied premium to realize and just a general overall level of volatility than what we're seeing in the S&P. A, do you concur with that? And B, do you have any, what was your take on the week's worth of action from an S&P vol perspective?
I thought basically S&P vol has been it seems like it's been driven by, the implied vol seems to be driven by whatever the latest cocktail in Europe is being mixed at any particular week.
I'm more of a mojito fan myself, so I'm not sure if that contributes to the volatility.
What's the cocktail in Spain? What's that wine?
Sangria.
Yeah, sangria. Oh my God, I can't believe I couldn't remember. It's because I've drank too many sangrias. But yes. Whatever the sangria is flowing seems to have been the implied volatility for the S&P, but the realized has still not really kept up with it really in any way, shape, or form. Like maybe one day a month, it feels like, or 2 days a month. So what we have seen, I thought, is the skew in the volatility seems to have come down quite a bit. So while the market might vacillate a little bit, these sort of the big incident, vol when we were getting those like steeper skews, seems to have gone out of the S&P. So Apple probably, yeah. Given I don't follow the NDX vol as much, so I can't even comment as intelligently as Mark would on the NDX. I'm pretty much just the SPX and SPY.
Speaking of you talking about that term structure and even indeed that volatility skew, I'd imagine given the relatively scant movements we've seen of late, except for yesterday where we actually had a little bit of movement in the underlying indices, are we pretty much holding pretty straight and true to the old skew path these days, or are we kind of starting to diverge? How are we moving along our skew trajectory these days in the S&P?
I think that it almost feels like the skew has got it all wrong because
it wouldn't be the first time.
We don't gap down anymore. We just gap up. But I'm looking at. I was just pulled up the Qs here to take a look at it for a little while. Oh wow, look at that.
People forget. They see vol skew as this kind of. I think a lot of, particularly retail, sees vol skew as kind of this. Just this is where vol has to be. This is the way the vol has to perform, and they forget how paper flow dependent that vol skew really is, and what the vol skew shows you versus what the actual predictions are could be two very different things.
And then the market will drop sharply, and you'll read in every newspaper and hear on every show. You see the fear gauge predicted once again.
Right.
It's a great headline, Don. It's a great headline.
About it every day for the last how many days? Like a stopped clock. It's right twice a day, huh?
My favorite is I know when things are getting interesting because I get the calls about VIX from Japan, and that's when I know that the word is out about the quote unquote fear gauge again.
Right. But I think it seems to be. I think as far as fear gauge goes, it's fear gauge, but just skew itself, I think it's contracting relative to the kind of the fear, quote, right? The worries that the euro seems a little less likely to totally disappear. A little, I think probably I would say those odds seem to have subsided versus like in early May. Right, when we saw like more 150% or more sides.
The notion of everything fragmenting seems to have subsisted for the time being.
It is for the time being. And I think if anything's driving any near-term volatility at all, it's just every time, there's some budget hiccup or riot or some nonsense. Even though all the news coming out today, I think actually that Spain bank news market turned around. I got that, Doc Mark. So I think we're as far as market directional goes and short-term volatility goes, it's still very much a euro-dominated game until it stops being a euro-dominated game. And I think that also probably sets a floor for us on the VIX at around probably 13. I think it'll be hard for us to break through that, as long as there is still the possibility of some, somebody, a bond yield going above 6% or something like that. But one thing I've noticed too, but the upside skew is a little flatter than it normally is. So there's a little more respect given to the upside than normal. And because funny, we were going through our gold class for iron condors, and you have to actually stretch a little bit to put on an iron condor right now that has any kind of decent return. It's just without those fat puts that we had over the last 3-4 months, the return on that type of trade looks a little bit skinny than it did before. It's just not as great.
Yeah, it's not the juicy premium sell that it once was.
Exactly. So it's sort of like, well, it's, when something's not as good, just don't do as much of it. You're like, okay, I just need this because I want to generate theta, but okay, the volatilities aren't that great. So just, okay, if it used to be a 10 lot, or a 20 lot, just do a 5 lot and be happy with it until you actually see the volatility rising.
Well, as Don would say, sell or don't sell, and it sounds like that is an ample or a perfect example of a don't sell opportunity, or perhaps you're right, just scale it back.
Yeah, at least if anything, scale it back. Just take the fact that you're not going to make a whole lot of dough doing it, but the market's sure not paying you anything. Don't do more to try to make up more money. Then you get.
Well, I used to be able to sell 10 and collect X. Now I'll just sell 30 and collect the same amount.
Now I sell 30.
That's how it works.
I'm going to get my money.
That's how it works.
Exactly.
It's revenge trading and kind of stupidity all kind of rolled into one. It's perfect.
Yes,
perfect cocktail.
Trade.
Speaking of cocktails, that's the perfect cocktail. A recipe, if you will, for success as a trader going forward. All right. Well, thank you, Andrew, and thank you, Don. I think with that, we're going to close out the old volatility review. And because you love it, backed by popular demand, we're going to dive right into the old volatility mailbag.
Listener mail. Listeners write in. Mailbugs.
All right, and welcome to the old mailbag. Here I am, just dusting off the mailbag. Got a little bit of dust in my face, but we're good now. It's open, and we're ready to dive right in. Of course, if you want to join the listeners who are chiming in on the program today, then by all means surf on over to theoptionsinsider.com. We have that brand new comment system that's just waiting for your voice to be heard. Just let us know what you think about the show or about some of the various articles that the people on the shows have written for us, or you can just post comments for Vol Views and we'll find them in there as well. A lot of different ways you can do it. Of course, you can also reach out to us on Twitter. We're just at options on Twitter, or even just send us an email, questions@theoptionsinsider.com. Just be sure to put Vol Views in the subject line. So we're going to kick it off with an email from Michael Veen or Vene, one of those two. So Michael, if I'm mispronouncing your name, you'll have to forgive me. And he writes, and this is actually a very timely question given what we saw a week ago in the SPY, is he writes, does volatility play a role in dividend exercise/assignment? Should I check my Vega before I pull the trigger and exercise my calls? And of course, just to recap for our listeners, what he's really referring to and why this is such a timely question is, of course, we saw a dividend. So we saw SPY, which is that very liquid ETF, go ex-dividend last Friday, which in and of itself is an event because so many people forget that SPY actually has a dividend component, which always cracks me up because it happens with like clockwork and people always forget it. And then B, it occurred on options expiration day, which simply magnified a lot of the risks involved in that sort of position. So we saw this kind of taken to the extreme last Friday, and it ended up costing people some significant money. In terms of your question, Michael, I think the easy and short answer to it is, of course, vol plays a role in just about everything you do in the options world. So you have to be cognizant of it. But in reality, is Vega a major factor in dividend exercise? In most scenarios, not. I mean, there might be some, when you're looking at exercising call options early to collect a dividend, you're primarily looking at those strip of deep in the money, and depending on the size of the dividend, maybe closer to the at the money, maybe even some near out of the money calls, depending on how juicy that dividend is. So you're looking at exercising that call early, but of course the price for that is that you're giving up all of that extrinsic value of that call. So what most options traders do is they use a little bit of shorthand. They look at the price of the put on that same strike, and if the value of that dividend is more than the the price of that put, which represents the extrinsic value that you're essentially giving up, then you will exercise that call early. It is economically advantageous for you to do so. So you can imagine, it's very rare, but I suppose it could happen. You have some explosive volatility scenario where the vol on even those deep in the money calls is just exploding, perhaps a takeover or something like that. It would have to be a very rare event. Then you might see a scenario where the vol inflates the premium levels on those puts to such an extent that it is no longer economically worth your time or your money or your effort to exercise those calls. And that's pretty much the only scenario I could think of where that would impact you. And of course, the flip side of that is that also, because it makes those calls less of an imperative to exercise, it also reduces your assignment risk on the short side. Of course, if vol is exploding that much, I think dividend assignment is probably the least of your worries.
If you have any Vega in the option, then you're going to need to rethink. You should be rethinking you should at least take notice of what you want to exercise, because generally the Vega should be going to about near zero if you want to exercise anything.
Yeah, you don't want to give up. You want to give up as little as possible of that juice. So if you have some substantial Vega, yes, I that's why I said this is somewhat rare, and I can't think of an occurrence. Perhaps maybe a biotech that had some takeover news come out or something like that, something that makes it relatively odd. On the exact same day that it went ex-dividend, you could see the confluence of events that has to occur to really make this a relevant thing. Don, in your broad scope of a trading career, have you ever seen a time when there was so much vol you didn't really want to pull the trigger? I suppose there are cases where vol is so high that, and the dividend is just so inconsequential that you're not going to pull the trigger. But have you seen maybe a moment where the vol just exploded to the point where a dividend you wanted to exercise early in the day now all of a sudden isn't the case? Of course, actually, I forget who I'm talking to. You probably never ever exercise a call early because you don't own calls.
I was going to say, you're assuming that I actually ever
I have to presume buying.
Owned anything. But actually, again, this would surely be more for individual names when you mention, possibilities of takeovers or wild events, more so than it would ever be something like an index option, most of which are European style to begin with. But when I first read this question, I wondered if it was a trick question because basically you don't exercise your option till after the close, till you see whether it's a deep in the money call or not. And as Andrew said, no effect of really implied volatility changes anymore. Value of the put, doing the synthetic, cost of carry if you now own the stock instead. You do all these calculations to try to figure whether or not it makes sense to actually do that early exercise. So the only way that I can see volatility having any type of a play at all would be, as you mentioned, Mark, in preparation for this, like during the day, if you were somehow or other in the money, but not very, very much in the money. Maybe the delta's not quite 100%, but volatility is very high. So there's the chance that by the end of the day, maybe there'd be so much movement that it would throw the stock to a level where the option now does have 100 delta, the call, and you would want, like, almost in anticipation of what could happen, as opposed to, wait for the close, see what the numbers are, and decide whether you're going to do it or not do it.
Yeah, like I said, it's an interesting question, Michael, and certainly very timely given what's going on in SPY, or I should say what happened in SPY. But it's really one of those 1 in a 8 million scenario that this would really become an issue. And certainly if this has happened to you, if you've seen this scenario unfold, then by all means write in and tell us what you saw, because I don't think any of us here on the panel can really remember a day. At least many of us, I guess, are not too active in pink sheet biotechs either, which you could probably, a lot of this stuff probably would go up. So yes, interesting question, an interesting thought exercise, Michael. I thank you for that. Now we're going to move on to a tweet from Ian K. He writes, can you talk a little bit about commodity volatility skew? Why is it so different from equity volatility skew? What about power/ energy skew. And, we've hit on skew many times on this show. We hit on it earlier today in the Volatility Review. It's a very common topic here on Vol Views. But he's right. Most of the skew we talk about is that typical investment skew. And that is really where, of course, the calls exhibit a markedly lower level of implied volatility than the puts. And there's a myriad of reasons why that is the case. We talked about it on the show. Quick shorthand, people like to sell calls for covered calls. People like to buy puts for protection. That tends to tweak the volatility skew. People are also primarily long the equities, so they have that bias as well, which leads to selling calls and buying puts. So there's a lot of psychological factors. People are long, so they get uncertain when the things drop, and they're excited when the market rallies. So there's a lot of factors that play into why that investment skew has that traditional shape we've all seen and all know and love. But you're right, on the commodity side, that is pretty much they flip that coin. That's the other side of it. And why is that? Well, it's pretty straightforward. If you have whatever the commodity might be, oil or corn or whatever the case may be, the volatility, the fear, the uncertainty increases as you're rallying because, of course, that product is now becoming more expensive, and that means a lot of interesting things. Of course, the user base for a lot of these commodity products, different than your typical equity option or equity product where most people are just investors. On the equity side, on the futures option side, there's a lot of end users, people who want to take delivery, people who are farmers who are producing that product. So there's a lot of volatility, you might imagine, and uncertainty as those products increase in price. There's a lot of dramatic impact in that. So we see a skew that is markedly different. And what that means is that typical strategies like covered calls are going to perform much differently in a product like that has dramatic juice to the upside as opposed to an equity option where the vast majority of them. I think someone wrote in a few weeks ago asking about when are the calls bid over the puts in equity skew, and that's a very rare scenario. Maybe Apple once in a great while when the zealots take hold of it, but that's a very rare scenario. So you're never achieving that level of premium, that level of juice for selling a covered call in an equity most times that you are in, let's say, a typical commodity. Now, Andrew, I know you guys have been doing a lot with corn over there of late, so you want to weigh in on this commodity vol skew question?
Yeah, well, mostly I have to sell some calls today because $2.50 gap in this little corn ETF that we trade. So we're back spread it, and I bought some gamma deltas yesterday, not enough though, because I was kind of a botch, but I have to sell. If I don't sell this rally today, I'll be upset. So yes, there's definitely the whole idea of skew is the shape of the curve as you go where the panic goes. Panic's to the downside. That's where go where the scarcity goes, right? If the scarcity is on the downside, you're going to see elevated downside skew like in the SPX or any equity. If the scarcity is on the upside, for let's say like corn or anything else, it's going to be up there. And actually, it was a little crazy for a while. It subsided. Maybe today I've got to look at it again. I've just been with clients all day, so I don't have the time to look at anything. But that's where you see that. And actually the skew for the VIX is a little weird because, one thing, the VIX can't go up or down, can't go up forever. So it doesn't have as steep a curve as a lot of other, let's say like oil or corn would go, because everybody's like, whoa, we could run out, So that has it has a different shape to the curve. And then like with the VIX, it's sort of kind of a frown. That's, my Chicago Italian coming through.
You're a fungi?
Fungi, like a mushroom.
Oh, yes.
Right, is upside down.
That's your bastardized, anglicized Italian. That's what that is.
It's my Italian aside.
As your representative Italian on the panel, I shall take the appropriate amount of offense to that, sir.
I'm Italian, too. I can say that.
Then, of course, you guys have summarized very well for commodities and, natural gas, crude oil, corn, whatever. Simply put, as you both said, if the problem is going to be to the upside rather than to the downside, then the skew is really kind of the mirror image of what we see for equities, as if you flip that skew around the vertical axis. There's one other that's different still that we may as well throw in for the sake of completeness, and that is FX skew when you're looking at currency. because here you're looking at currency pairs. Let's take something like the price of the euro with respect to the dollar or vice versa. Here, what you really get is a U-shaped curve where the at-the-money volatility tends to be the low point, and as you go in either direction, you get increasingly higher implied volatilities as people play for the movement of the one or the other currency, and there's really just no reason to be biased one way or the other. Here, when you talk about what's the panic, well, it's two-sided. So basically, look at the euro price today, $1.28, $1.29. People worried about that, saying, my God, it could go to $1.20 or all the way down to parity. We've seen it, of course, in the 140s and the 150s. So the demand is two-sided in this case. And whether it's the puts or the calls, you've got that lottery effect where people are willing to pay up for hitting the home run if there's big movement in either direction, and there's no natural demand for, puts on the side of equity or calls on the side of commodities. So the skew for FX is this kind of a parabola or U-shaped curve, which is sort of, different from either of the ones that we've just discussed.
And, of course, the second part of his question has to do with power or energy skew. And that's actually, I've never really traded power. I've never been one of these guys down in Houston slinging power. But I'd imagine the skew has to look somewhat like a commodity skew because it has that same issue there, Andrew. Not so much scarcity, but I think just, the fear, the impact, the volatility from energy certainly comes as the price per kilowatt goes up. So that's probably...
you can have energy outage, right? Because sometimes what happens is there's no energy.
Yes.
And then you're stuck like California, Gray Davis, lock yourself into a 10-year contract to buy energy at the very
yes.
peak of the market.
That perhaps might have been one of the best, and by best I mean horribly worst trades I've ever seen done, where you lock yourself in on one side to the price you could sell it. On the other end, you're open to a free market where people are going to gouge you to death, and of course they did. And still amazed that just shows politicians and how dangerous it is to have them setting any sort of economic policy. Yes. But yes, power.
Only if they're a Goldman Sachs alumnus. Those are the only politicians you can give money to. Robert Rubin or Hank Paulson. That's it.
There we go.
All the rest, no money.
Because they know how to move markets. Maybe they don't know how to understand markets as much, but they know how to manipulate markets. So that's also a useful thing.
Get something for their dollar, right? If they're going to spend money, they're going to get an asset.
Yeah, that's true.
10 cents on the dollar.
That's true. That's true. They'll buy us a card company for cheap.
Yeah, I think the power skew that would probably have, it has to mirror there probably has kind of a spiky characteristic to it, fairly steep probably relative to, because of the, that actually it's just a guess because I've never traded it, but if you're moving, it has to move in that kind of the direction though.
Yeah, and you're right. It might have that interesting downside tail characteristic because, of course, zero power is also of concern. So there might be a little bit more of of some juice on the downside there than you would see in other commodities or other types of skew. All right, thank you for that question there, Ian. An interesting one indeed. We like to always mull skew here. Next up, we have a Facebook question from Christian Garcia. He says, I've been listening to you guys since day one. So first off, Christian, let me thank you for that. We love hearing that from our listeners. And let me just say, he goes on to write, great job on explaining things and what they really mean, especially all the special guests you guys have. So there we have it, Don. Another appreciative listener for all the guests we've wrangled here on the show. That's always nice to hear.
And there are going to be more.
Yes, there are more coming. Certainly, I think on the old Options Insider Radio Network, no show can vie with Vol Views for just not only the sheer amount, but the sheer weight of the guests in terms of their interest and impact. It's been a fantastic group of guests we've been able to wrangle. More are on the way, and the next part of his question goes back to something we've been discussing really since the first episode of this show. And he says, my question to you guys is about gamma scalping. Is it worth it to be stuck on the screen all day? And he continues in parentheses, long straddles. There's a second part to this to this question. Maybe we'll get to that in a second. But his part here about gamma scalping, I think we'll start there. And, Don, we've talked about this a number of times on the show, including episode 1, where we talked about the typical way most people trade volatility, and, of course, the way Andrew and I kind of grew up on the floor, which is delta neutral. And so you're looking to capture volatility through this delta neutral type of approach. And what is required in that, and what he's talking about here, Christian Gamma, is a technique called gamma scalping, because, of course, you have a gamma to your position. Your delta is changing as the underlying moves throughout the day. So the bulk of our time, at least for me, Andrew, and probably for you too, I'm guessing, when you were on the floor, the bulk of your time was spent working gamma scalps throughout the day. I mean, particularly must have been for you, because I know you're a degenerate juice buyer, so you must have been scalping all day long. If you're on the short side of the equation like Don, you tend to hold back and don't hedge as often, because that's locking in losers, of course. But so when you're long straddles, like he asks here, or long any sort of real premium position, you have that gamma scalping component. That's one of the reasons why I've typically been hesitant for whenever someone writes into the Options Insider and they fall into the basic or even intermediate end of the retail spectrum. I've been hesitant to really counsel them to do any types of trades like this, like a long straddle, because the only way to really make these types of trades really pay off for you in the long term is to be able to fight against that decay. And the only way to really fight against that decay effectively is to scalp your gamma. And there's a lot of different ways you can do it. You can use options to do it too if you don't have the money to do underlying stock. But essentially, it's a very laborious process, very time consuming. And I would say, I mean, your example here, long straddles, I wouldn't counsel most people to be long straddles anyway, unless it's a very particular scenario. I just, those things die a little every day, as Don likes to say. But yeah, I typically, I don't know, Christian, I don't know your setup. I don't know if you're doing a lot of trading actively right now, and if you're at your screens all day anyway. If you're at your screens all day anyway, and that's become kind of a part of your job in many respects, then yeah, I think it might be worth it, particularly if you're going to be trading long straddles anyway. So if you're going to be trading long straddles, regardless of what we say here today, then yes, by all means, make sure your account is capitalized enough so you can scalp gamma, because it's the only way to really defensively, it's the only way to really defend those types of positions and allow them to stay on your books long enough to actually work for you for that one day out of the cycle, whatever it is, where they have that massive move and all that long gamma, all those deltas pay off for you, and you actually make some money on that trade. If you have to defend that position in order for that moment to come along, and the best way to do that is from gamma scalping. So if you're going to be trading straddles anyway, then I would say yes. If you have a day job and you're thinking about maybe getting into long straddles, I would first counsel you perhaps not to do that, and then and definitely don't go into the long straddles if you're worried about having the time to do gamma scalping, because those things pretty much go hand in hand. And go ahead, Don.
The other important thing, everything you've said, of course, is absolutely true and correct. But again, we don't know the nature of our questioner's situation, but a tremendous difference in cost between a market maker scalping all day long with his setup in terms of commissions, bid offer spread, and what have you, and a retail client trying to buy or lift offers, sell on bids, pay commissions every time he does a trade.
That's true.
There's a fine line as to just scalping how much you're making. It's never a great deal. It's small amounts, multiple amounts of time, but those commissions and that bid offer spread will eat you alive if you're on the wrong side of them and constantly paying them in order to get these follow-up trades off. So in many cases, whatever profits might be there, if there are any at all, that might accrue to the market maker, it's a very different situation when you try to put on a different hat and say that you're a retail customer trying to do this. You can very quickly go from the positive side to the negative side just because of the commissions and the bid offer spread.
Now, Andrew, what do you typically counsel your clients, your mentees, when they come to you with this?
True juice seller.
Yeah, and furthermore, it sucks to begin with.
I think the reality of this is what I do is when we teach the class on buying gamma, basically what I'll call essentially is a long gamma trade. is you have to have the ability to manage the position, right? The whole idea of a position is you're scalping gamma. You're not scalping gamma to make money. You're scalping gamma to break even. And
yes, it's defensive.
You have to have an expectation that volatility is going to rise. So the first thing we do is we start with, if you're not buying, we basically teach people how to look at conditions where volatility looks relatively cheap. You just don't go into the SPX and say, I'm going to buy a straddle and scalp it, and hope everything works out okay. You need to buy cheap, and I would say right now the SPX or the SPY is the wrong place to buy an at-the-money straddle, because you're going to watch it rot because it's not moving. So the first thing is trying to figure out what is your level of engagement on a daily basis, because you could put orders in to scalp. If you buy something cheap enough, you can put orders in ahead of time to either scalp your stock, you can scalp an option, and you can just scale things in. And as soon as something gets filled, you put a bid in to buy it back. But you need, I would say number one is you need cheap options to buy first. We actually go into several levels of how you buy premium in a relatively intelligent way. You just don't go buy. I would not tell anybody just to go out and buy a straddle and sit there and try to scalp it all day. I think that's a path to ruin for the most part.
Yes. Despite what some previous educational companies might have marketed back in the day in the make money in any market condition using straddles.
That's total nonsense. You basically, for the same reason that Don likes selling options, because he believes that essentially the gamma is overpriced because implied volatility is too high, you need to find options where the implied volatility is pricing the options too cheap. And because they're sometimes options are too expensive, I think sometimes they're too cheap. I think the ratio of finding a long gamma trade versus a short gamma one is there's probably 10 good short gamma candidates for every one good long one, realistically, as far as that as a strategy to make reasonable dough.
And I think Don would probably even dispute that one. So
yeah, he'd say it's like 100.
Sell it or don't sell it. I'd take the 10, and then when the one rolls along, I say, you know what? I'll just watch for a little while.
Exactly. He basically his MO is it's all a sale. But one I might not sell just because it doesn't Twitter me enough.
Yes, exactly. And of course, the second part of Christian's question here, it actually is for Mr. Sebastian, who is not on the show, so I won't attempt to answer for him unless, Andrew, are you very familiar with his pay the decay formula they discuss in that book?
I do. Actually, we use it.
Okay, so let me read out this question then, and you can answer for Mark here. He says Christian goes on to ask, does Mark Sebastian's formula work on options on futures like E-mini S&P? The formula that I'm talking about is the, quote, pay the decay formula that's in his book. Thank you, guys, and keep up the good work. And so, Andrew, since you're affiliated with Mark, I'll let you speak for him.
We use the pay the decay, and what we try to teach people is if you're going to buy options, the stock has to have some kind of story behind it, enough that it has a reasonable chance to drive past the average realized volatility on a daily basis. So what you got to figure out is what's that number, and the decay number in Mark's book gives you an idea of what that number is. So if the number is like 65 cents a day that the model generates from the position, right? Because the pay the decay number takes the Greeks and translates them into market movement. So you're trying to get an idea of, okay, I have these Greeks, I have this gamma and theta, and how is this going to work for me? How do I make these numbers pay? And the formula takes that and just gives you a simple way to figure out, this underlying is trading 65 cents a day. The problem is lately it's been moving about $1 a day. So I think if I buy options here, I have a reasonable chance to trade out of them at a higher level because the gamma is going to overrun the option value. They're going to pop a little higher, and I think the FXE has been a good trade like that lately. It's trading around 8 volatility, and the thing just like 2 to 3 days in a row, like gaps 50, 70, 90 cents. Boom, you're out. So you start with a delta neutral trade, and you look at it on how reasonable you can even start, that the option position has a chance to outperform. And I think, is that formula work? I think that's a great place to start. That's not the only thing we teach. We actually have several other things we like people to look at before they jump in. But that's definitely a key part, because if it doesn't pass that sniff test, you're like, you're like Don. I'm the opposite. Like, I haven't seen an option. I shouldn't even say that, because there's a ton of options. But if it doesn't pass that initial sniff test, then you pass.
Yes,
or you mark kind of on your list for something to look at later until it gets more interesting.
Yes, and of course, I think it's probably worth mentioning, too, that there's a little bit different beast with options on futures, but that same methodology can be applied across a variety of products, not just on, let's say, your typical equity option. That was, of course, the other part of his question. Does it work on options on futures? And yes, I think it's probably worth reiterating here before we close out the old mailbag that the point that Andrew and I both brought up, and it's worth reiterating again for a lot of our listeners out there who are thinking about gamma scalping. I think they conflate gamma scalping as this great path to riches, when the truth is exactly what you said, Andrew. It's defensive. You're there really to defend and try to offset this enormous amount of decay you're incurring with these long positions like these long straddles. So 9 times out of 10, gamma scalping is not going to be the thing that makes you $1 bazillion. It's going to be the thing that keeps you in the game long enough for your position, for your whatever your viewpoint on volatility or underlying, whatever that may be, to actually pay off. And so
exactly, Mundo.
You know what's kind of interesting, guys, and I've done this at many seminars. I have a section that talks about delta neutral trading and explains the dynamics of it, and then I actually do get to a formula that's different from the one that Mark uses. We were kind of discussing it through emails this morning, and maybe we'll take it up again next week, and I can kind of offer sort of shortcut methodology for calculating the same value that his formula does. But what does become very interesting when you're standing in front of a group of 100 or 120 people, and you do manage to come up with a rather good mathematical estimate of how much the underlying has to move, not just today, but every single day, in order to overcome the theta, which is ever present and doesn't go away. And, as I like to say, they die a little every day. So you buy a straddle and you realize that there's time decay. If the market doesn't move tomorrow, those options are going to be worth less than they are today. And we have a number that tells us how much. So the whole purpose of this discussion and the question is, how much does the underlying have to move today, either up or down, it doesn't matter, so that the movement, which will produce a change in the options value due to delta and gamma combined, both of them, will overcome the decay of the one day to both the call and the put. So you come up with that number, and then you turn to the audience and you say, well, what do you think about that? You guys watch the market every day. You know how much the S&P moves. You know how much the Dow moves. Supposing I tell you that the S&P's got to move 12 handles every single day on average. So, no good if it moves 12 today and only 6 tomorrow. It's got to move 12, and then it's got to move 12 again, and it's got to keep on. It's got to average 12 every single day, for you to overcome that theta. How many of you, think that it can do that and would want to trade this on the long side? I'll bet we don't get more than about 10-20% of the hands going up. So it's kind of interesting when you confront them with the actual numbers, that bogey of how much you've got to move on average every day that you hold this position, day in and day out, in order to become profitable. Intuitively, it starts to not have the kind of luster that it usually does when you describe these things as infinite reward and limited risk. that part always sounds wonderful until you start examining the numbers, and then all of a sudden people start shying away, and they say, I think that's a tough nut to overcome on a daily basis.
Just like math, to take the luster off those all things. But yes, that's an interesting point. You can't really argue with the numbers when you're confronted with them up front. Thank you for that question, Christian. And we encourage all of you, like I said, to reach out to us just like Christian and the rest here did on Twitter, on Facebook, on our comment system on the website, or of course just shoot us an email, questions@theoptionsinsider.com. But that is going to do it for the old mailbag for this week. And now we're going to dive right into our crystal ball segment.
And now we take a look at the crystal ball.
All right, that haunting melody means it's time for our final segment. That is, of course, the crystal ball, where we attempt to peer into the murky ether of the future to divine what the volatility gods have in store for us for the coming week. We'll start with you, Don, in the land of Apple Plus, a.k.a. NASDAQ, and what you're seeing on the old on the old NASDAQ volatility horizon.
Watch that. I was out on a limb last week, and you got me to say I think that volatility might be going a little bit higher, and managed to do so. And I hate to continue to be along that vein as we do start to go a little bit higher. Then it becomes perhaps less likely that it persists. But we had quite a long downtrend in NASDAQ volatility. If you look at any kind of a graph, let's say of 21-day moving average of realized or historical volatility, was up at around 22 or 3 at the beginning of July, and more or less just went straight down to under 10. We saw those 8 and 9 levels to the beginning of the month. Well, we've been rising since then. And it's always difficult once you reverse a trend to say when it's going to stop. But, once again, if you put a gun to my head and said, you're just talking about the next week, I'll press my luck once more and say probably still a little bit higher, a little bit more to go on this little leg of up movement in volatility.
Let's see if the tech sector, or if indeed Spain, can contribute some love to that and make your prediction come true next week there, Don. And Andrew, of course, last but not least, what do you see in your crystal ball for the land of S&P volatility?
Actually, I'll take the other side of Don, very small. And I think it's going to sit. The Spain stress test is now done. Now we're looking to next week. We're looking for non-farm payrolls, and that's kind of, if we, probably the bottom of the volatility would be sometime in, maybe Monday or Tuesday of next week, short term, and then it'll start to ramp back up as everybody's worried about what the non-farm payroll number is. So that's been the pattern pretty much for the last 4 months, and I'm going to stick to it. So I think that's kind of where we are today.
I think our friend Sean from Options Express made an interesting, perhaps a little scary point on the show yesterday. I'll just repeat it here on Vol Views, Don, that there's only 2 non-farm payrolls left until the election, which is crazy to me that the election has come is in that close proximity to us now, where we're actually talking about it as this very, very tangible thing with very tangible impacts on the marketplace. So a scary thing that we have this. It's becoming real. So.
I think, without really discussing any of the politics of it, but just simply the dynamics of it, I think that when an election is very much in doubt and very much up in the air, and the potential for a very close election with 2 extremely polarized and different candidates, then that can create volatility in the market just because of the uncertainty. As the polls start to favor one of the candidates a little bit more strongly than the other, and I'm not going to say taking all doubt away, but making things a little bit less uncertain than they might have been a few weeks ago, then the potential for volatility starts to decline a little bit, at least the component that would have to do with the outcome of the election, as some of that uncertainty starts to, kind of unwind and unfold. And volatility is always about, uncertainty. So if you start to remove one aspect of that does have that kind of effect.
Yes, so we'll have something to look forward to. Hey, maybe that's the time when you want to start getting into your gamma scalping, when all that vol is coming along. Maybe the election is the time when you want to do your gamma scalping. That's when we get a little bit of, if past elections are any indication, we might get a little bit of juice out of that one. Hopefully not like 2000 juice. That was off the charts insane. But something perhaps a little bit more manageable and a little bit more sensible for all involved. All right, and that's going to bring our crystal ball segment to a close, and unfortunately also this episode of Volatility Views. But before we go, I want to give my partners in crime here a chance to let us know what's going on in their respective necks of the woods, starting out with Mr. Lobster himself, a.k.a. Andrew Giovinazzi from Option Pit by way of Maine. What is coming up in the land of the pit?
October 7th, we will be in New York with T3 for stock traders to actually use options to help maybe deaden some of the blows sometimes of active daily stock trading. So that'll be Sunday the 7th. And also Mark Sebastian will be at KYO next week, right? Like on a Tuesday, they're starting their new series.
Yes, he will be doing a webinar for the KYO boys, our other friends, over there next Tuesday, I believe.
And just walk on over to at www.optionpit.com in our events section, and you will see all of the goodies that we have up and going.
And of course, last but of course not least, Don, what is new, what is interesting, what will catch our eyes over in the land of Volex.us?
Well, there's so much going on behind the scenes. I sometimes get announcements from our CEO, Bob Kraus, and Charlie Barwis, as they go to various meetings with exchange officials, and I attend some of those meetings, but not all of them. They had a wonderful meeting yesterday, and I hate to be cryptic, but I haven't even run by them yet whether we can announce this or not, but has to do with options on vol contracts and how they might eventually be listed and by what exchange or exchanges. So we continue to make great progress with our product placement and how this is all going to come together when we bring out what we hope will be an entire suite of products for vol contracts, vol options, and perhaps even ETNs or ETFs on the vol products for indices. So we continue to make a great deal of progress there. And I announced last week that we had this major research paper that was done by one of our friends over, a former student at IIT in Chicago. So we will actually try to have him on the show as a guest in the near future to discuss that paper and its findings. Finally, just a little coming attraction. We talked about guests, and we're trying to book dates again and line up guests now that we're back from our summer hiatus. And a good friend of the show and of the Option Insider Radio Network, Mark Kavanaugh, will be joining us.
Actually, that's Mike Kavanaugh, so try that out.
I'm sorry.
No problem. Too many Marks. I know, it's confusing.
My apologies to Mike. But Mike has already had one stint on the show, and he's going to be returning next week, and we'll be happy to have him back. Mike from Know Your Options. So we look forward to his visiting with us next week.
Indeed. Always fun to have good Mr. Kavanaugh on the old program. And, of course, that is going to do it for us this week. But before we go, I also want to remind you to visit the newly revamped OptionsInsider.com. You can, of course, post your questions and comments there for us to read. You can also read all the latest options education and analysis and unusual activity and breaking news from the options market. And, of course, find all your favorite episodes of Volatility Views, as well as all of your other favorite programs on the old Options Insider Radio Network. And so until next time, we'll see you right back here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.